Hi everyone and welcome to this YouTube channel. In this video, we are going to talk about the 15 best real estate investment strategies in America. So before starting this video, please like this video and subscribe to our channel for future updates. 1. Fix and flip. The fix and flip strategy is the business of finding properties that need work, doing the repairs, and reselling them at top price for a profit. If you've ever watched the flipping shows on HGTV, this is what they do. I used this model for much of my early years in real estate in order to pay the bills and generate cash savings for future investments. It was not always easy, but the beautifully finished houses and the sometimes large chunks of cash were rewarding. 2. Wholesaling. Wholesaling is the business of finding good deals on investment properties and then reselling them quickly for a small markup. The crux of this business is being good at marketing and negotiating to find those good deals. If you're good at sales, you'll like wholesaling. But if the idea of sales makes you cringe, I'd look for a different strategy. I also began my real estate career doing a variation of this strategy called bird dogging. I essentially hunted down deals for other more experienced investors. I then got paid whenever they bought a deal that I found. 3. House hacking. House hacking means living in a home that also produces income, like in a duplex, triplex, fourplex, or house with extra rentable space like a basement, guest house, or spare bedrooms. By renting out part of your residence, you can reduce your total housing costs. House hacking is also an amazing strategy because you learn the landlord business while living at your rental. And once you are done living there, you can move out and transition the property to a long-term rental. 4. Live in then rent. Live in then rent is simply living in a house that will eventually become a rental. This means the house must work as your home and as an investment later on. But unlike house hacking, you don't rent the property while you live there. Doing this strategy a few times is a great way to build a small portfolio. And you don't have to live next to your tenants like house hacking. 5. Live-in flip. The live-in flip is a strategy where you buy and move into a home, fix it up, and wait 2 years or more to resell it for a profit. If you follow the IRS rules, you pay no tax on the profit up to $250,000 for an individual or $500,000 for a couple filing jointly. My friends Carl and Mindy Jensen from the blog 1500days.com used a few live-in flips to amass savings of several $100,000 early in their careers. You can read their story in Getting Rich with the Live-in Flip. 6. BRRRR investing. BRRRR stands for Buy, Remodel, Rent, Refinance, Repeat. When done carefully, it's an excellent way to build a rental portfolio without running out of cash early in your investing career. Essentially, you look for fixer-upper properties that you can buy below their full value. You use short-term cash or financing to buy the property, and then after it's fixed and stabilized, you refinance with a long-term mortgage. If done well, you can pull most or all of your original capital back out for the next deal. While I like this strategy, I think it's best when used early on to first build your portfolio. Eventually, it's smart to transition to lower leverage and lower risk approaches instead of constantly leveraging as much as possible. An example of an ideal transition strategy is the rental debt snowball below. 7. Short-term buy and hold rentals. This strategy involves buying and holding rental properties for relatively short periods of time, perhaps 1 to 5 years. Often the purpose of this strategy is to force property appreciation, aka add value, by remodeling, raising the rent, decreasing expenses, or all of those. The short-term buy and hold strategy works very well for multi-unit apartment turnaround projects. It also works well for rentals in high-priced, appreciating markets that don't cash flow as well. 8. long-term buy and hold rentals. This is the strategy of owning real estate with the intention of keeping it for the long haul. The benefits of this slow and steady, and very successful, strategy include rental income, tax shelter from depreciation expenses, amortization of loans, and price appreciation. I continue to use this strategy, especially on my properties in the best locations. I like to keep these properties because they attract the best tenants, are the least hassle to manage, and tend to appreciate the most over time. 9. The rental debt snowball plan. The rental debt snowball plan is one of my favorite strategies to predictably build wealth, reduce risk, and eventually create an ongoing income stream from rental properties. It basically involves gathering all of the cash flow from your current rentals and any other sources, and then concentrating that cash flow to pay off one mortgage debt at a time. The magic of this strategy is the speed that debt payoffs start to snowball, i.e. accelerate, over time. If you'd like to retire within 10 to 12 years or less, check out this rental debt snowball case study. 10. The all-cash rental plan. The all-cash rental plan is similar to the rental debt snowball plan because it snowballs rental income for growth. But instead of using mortgages, you just save up cash and buy a rental property without any debt. Some financial teachers like Dave Ramsey advocate this type of investing. It would be tough to get started with all-cash investing in a high-priced market, but in many areas, it's still a great plan. 11. The trade-up plan. The rental trade-up plan is perfect for entrepreneurial investors willing to juggle a lot of moving parts. This strategy is a way to quickly build real estate wealth and income by moving from smaller to larger properties, typically using a technique called a 1031 tax-free exchange. 12. Hard money lending. Hard money lending is the strategy of making short-term loans to real estate investors who buy rentals or fix and flip properties. Usually, the loans involve high interest rates, points, i.e. upfront fees, and lower loan-to-value ratios. While the strategy can be very profitable, it also has large risks. If you have to take the properties back at foreclosure, you need to make sure you're protected. I recommend educating yourself well before doing hard money lending, beginning with Ian Ippolito's free hard money lending guide. And if you're very serious, you should consider paid education with my go-to teacher on the subject, Dykes Bodiford's hard money lending class. 13. Discounted note investing. Discounted note investing means creating or buying notes, i.e. real estate debt, at a discount to the note's full value. Because of this margin of safety, you can create large returns and reduce your risk. One form of discounted note investing involves buying notes, typically those that are delinquent, from other owner financing sellers or from banks. This is a much more advanced strategy, so I recommend studying it carefully before jumping in. You can begin with note investor Dave Van Horn's book Note Investing. My experience with discounted note investing came from creating my own notes. I sold some of my rental properties to my tenants using seller financing. For example, I had approximately $70,000 invested in a property. I then sold the property to my tenant for the full value of $100,000. But instead of my tenant getting a loan at a bank, I became the bank. The buyer paid me $10,000, and I financed the $90,000 balance, i.e. received monthly payments of interest and principal. While this is a profitable strategy, federal and state regulations like the Dodd-Frank Act have made it much more difficult for small investors to navigate. While there are a few exceptions, small investors must follow many of the same, expensive rules as large lenders. So, get help from your local attorney before beginning this strategy. Passive strategies. Although some of the passive strategies below still involve important upfront investment decisions, they require less day-to-day hassles than some of the prior strategies. 14. Syndications and crowdfunding. Syndication is essentially pooling your money with other investors to buy real estate or make loans. It's a way to invest in any of the other strategies mentioned above without having to put the deals together yourself. You invest your money with syndicators or general partners who find and manage deals for you, and they receive a fee. Crowdfunding is a relatively new form of syndication investing where deal opportunities are marketed through online platforms like PeerStreet. This is an affiliate link. Most require you to be an accredited investor, but you can sometimes begin investing with as little as $1,000 to $5,000 per investment. I am beginning to explore some of these syndication deals myself, and one of my favorite sources of information is Ian Ippolito at the realestateCrowdfundingReview.com. Although I put syndication, crowdfunding as a passive real estate investing strategy, this is a bit misleading. Investing in syndications and crowdfunding can be very easy and passive, but successful investors with this strategy are still active. 15. Real estate investing trusts, REITs. Real estate investment trusts, i.e. REITs, are very similar to a mutual fund. But instead of allowing you to own a piece of many stocks or bonds, these REITs allow you to own a piece of many commercial, income-producing properties. And unlike most of the other investment strategies above, this strategy truly is passive once you buy it. Thanks for watching.